It's important to understand that often people look to break markets down into growth and income, but ultimately, if your company is growing quickly and earnings are growing quickly and free cash flows are growing quickly, then over time, your income and the dividends that you're receiving are growing quickly too. So we're a big believer that if a company's growing strongly, then the income side of things will look after itself over time.
Whilst the REITs have been basically left behind, they've been very much an overlooked part of the market, and I think some of the characteristics have been just too easily overlooked as people have been too excited about growth prospects and not looking at fundamental underlying valuations and the ability to have a diversification element. And the diversification element for us with real estate is that the fact that you're actually buying hard assets, that you're really not paying much more than replacement cost. And that's usually a signal that there's some actual value there and the ability to provide some real diversification in a portfolio.
The banking sector, the IT sector, and even some of the large cap quality industrials are still screening quite expensive relative to history. But there are pockets of value. The cyclicals look quite good. I think small to mid caps we think look relative value. And also the property sector I think looks quite interesting.
Industrials, a lot of it is sort of older economy. Sometimes they're quite boring but stable business models. And so I think a few of those have been overlooked in favour of the more glamorous technology names. And so what that has meant over the last 2 or 3 years, we've been able to find, really high quality niche businesses that do what they do incredibly well, dominate their market, and they've been relatively attractively priced.
We think that using a little bit of gearing actually is going to be a really attractive way to compound wealth over the long term. It means that you're going to get a lot less volatility in your investment portfolio, and it means in periods when gearing is not going to work, like a sharp drawdown, your capital is going to be, there's going to be a greater degree of capital preservation.
Particularly given the volatility we're seeing right now, I think there is always a time for global equities in a portfolio in terms of diversification. And I think, look, even when we launched the fund 7 years ago, the point was our shareholders didn't have diversification. Many of them had huge exposure to Aussie stocks and Aussie dollars. So there was definitely an argument to have global equities in their portfolios. I think particularly at the moment, we're seeing lots of stocks selling off. So even great companies, you're getting at better prices. So we think it's an absolutely great time to be allocating to global.
The economies are still growing. There have been some turbulent times. China's obviously had the property market headwinds. There's a lot of negative talk around tariffs and things like that I think put global investors off. But nevertheless, like when you look, whether it's across Southeast Asia, you still have a lot of growth opportunities, rising middle class. China is still, progressing along their development path.
We're actually seeing a continued structural change in terms of demand for credit away from the banks. And certainly from our perspective, what we look to do is find good quality clients that we can do business with. We want to do repeat business with them, and we want to understand their business or the nature of the projects they're undertaking, and then obviously be a very strong finance partner for them.
Understanding what those trade-offs are, that might be factor tilts in terms of your equity sleeve or certain concentration risks. So investors need to ensure that they make informed decisions around those trade-offs and understand the risks they're taking in constructing income portfolios.
What's also changed through time is accessibility to genuine fixed income solutions has improved incredibly, particularly with the creation of ETFs, and in our case, active ETFs. So whilst in the past investors had to seek alternatives because they couldn't get these genuine solutions, those genuine solutions are now available. They're easy to access. They're on exchanges like the ASX, and they can be easily tradable. And so I guess as clients reevaluate, well, what are they going to do with their investments in hybrids? There is now a much greater array of good ideas that ultimately will suit different purposes for different people.
Think about the narrative change we've seen in only less than 3 months now. Start of the year, ourselves included, we're saying America first, US exceptionalism, and the rest of the world is uninvestable. China, don't touch it. Europe coming out of a recession, but weak. 3 months later, make Germany great again, fiscal spending there, everyone shifting their allocation away from the US into Europe and even into emerging markets. So a lot of volatility has occurred at the macro level. Now that's great if you're a multi-asset investor trying to figure that out, but if you're actually remembering, ultimately, longer term performance is driven by company fundamentals. So if you're a stock picker and you're hit with some of these large moves we've seen in the last few months, that provides ample opportunity to buy attractive stocks that can compound over a long time period. So you think about what this volatility means for picking stocks, it means you have to be active again. No longer do you have to go, okay, and buy an index. Like, no, can this individual company survive a trade war? Are they going to benefit from the new government policies that Trump or others are initiating? Can they pass costs on to consumers if inflation stays stickier than normal? So active management, looking through the noise in the short term and finding companies that are very highly qualified or can compound their earnings over time becomes important again.